Welcome to today's Explainer. You already know how an initial public offering works on paper, right? But man, if you've ever tried to actually dig into the sheer mountain of paperwork required to take a company public, well, it honestly feels like looking for a needle in a massive financial haystack. So today, we're cutting through all that noise. We are going to visually break down the literal anatomy of an IPO.
So, how exactly do you decode a 400-page red herring prospectus? I mean, the RHP is the foundational document of any IPO, but it is just incredibly dense, packed to the absolute brim with jargon. We're going to distill the whole thing down for you so you can actually make an informed decision without spending your entire weekend reading legalese.
Seriously, just look at this massive table of contents spanning multiple pages. It covers absolutely everything, from risk factors to capital structure and literally pages upon pages of restated financials. Let's be real, most people never read past page 3. So we're going to use the Aastha Spintex Limited IPO as our real-world case study to navigate this maze and pull out the info that actually matters. All right, Section 1, Meet Aastha Spintex Limited. Think of this as a financial coming-of-age story. According to the document, Aastha Spintex was born as a private limited company in Gujarat way back in August 2013. And now, after years of grinding and operating, they are officially graduating to the public markets in 2026. This jump from private to public, it's a monumental shift. It opens them up to intense public scrutiny, sure, but also gives them access to massive capital potential. And as an investor, the very first thing you look for is that money. Notice this bold number right here, 17,000 lakhs. That represents the absolute total size of the fresh issue they're aiming to raise. Basically, the company is creating brand new shares, meaning all this capital is going to flow straight into their coffers to fund their objectives, rather than just cashing out the existing shareholders. Now, the document explicitly states this is a 100% book-built issue. What does that mean for us? It simply means there isn't one fixed price right out of the gate. The market actually gets to help discover it. The company and its managers set a floor and a cap price. Investors like you and me place bids within that band, and the final issue price is determined by where the demand actually sits. Pretty cool, right? Moving on to Section 2, the key players. Here we have the book-running lead managers. We're looking at BOI Merchant Bankers Limited and PNB Investment Services Limited. You'll find their logos stamped right on the front page of the prospectus. Think of them as the primary architects managing the entire IPO process. They help determine that price band we just talked about, ensure all the regulatory compliance is locked down, and they market the issue to institutional investors. And handling the actual mechanics of your applications? That's the registrar to the issue. For Aastha Spintex, this is Big Share Services Private Limited. Look, while the lead managers are building the house, the registrar is basically handling the plumbing. They're responsible for processing the bids, finalizing the basis of allocation, and making sure the shares actually hit your DMAT account, or, making sure your funds are unblocked if you don't happen to get an allocation. Next up, Section 3, the bidding timeline. You've got to notice the rapid-fire nature of this schedule. The institutional anchors, they get to bid first on Thursday, June 25th. But the public? We only get a tiny 3-day window opening on June 29th. If you're actually planning to invest, this document makes it crystal clear. You cannot drag your feet. You have to be ready to act within this highly specific blink-and-you-miss-it timeframe. Section 4, slicing the investor pie. Before we look at your slice of the pie, you have to remember that the lion's share usually goes to the QIBs. Those are qualified institutional buyers, like massive mutual funds and pension funds. Because they bring the really heavy capital to the table, they serve to anchor the entire issue. Check out how the regulatory quotas are actually mapped out in this offering. Because it's a book-built issue, QIBs are capped at a maximum of 50%. This leaves some very specific, protected carve-outs. You've got a minimum of 15% reserved for non-institutional bidders and a minimum of 35% specifically blocked off for retail individual investors. So why does this actually matter for you? Well, if you are an everyday retail investor applying for an amount up to 2 lakhs, you fall right into that 35% minimum allocation bucket. This whole structure is purposely designed by regulators to ensure that retail participants aren't just completely crowded out by the massive Dalal Street heavyweights. And finally, Section 5, reading the fine print. It is kind of tastefully ironic. Despite hundreds of pages of intricate corporate history, detailed financial projections, and upbeat industry outlooks, The very first general risk explicitly stated in the document bluntly warns you, do not invest unless you can afford to take the risk of losing your entire investment. I mean, wow. It is a highly sobering reality check, printed right there at the beginning of the prospectus.
Then there is this stark disclaimer. It's a regulatory requirement, sure, but it is absolutely essential to understand. Quote, the equity shares in the issue have not been recommended or approved by SEBI, nor does SEBI guarantee the accuracy or adequacy of the contents of this red herring prospectus. Listen, just because an IPO is happening legally doesn't mean the regulators actually think it's a good investment. The absolute responsibility for the contents of the document lies totally with the issuer, not the government.
Furthermore, the document explicitly calls out the risks of this being a first issue. Because Spintex has been private until right now, there's been zero formal market for their shares. The pricing is just an assessment of demand right now, but the document explicitly states there is no assurance of an active or sustained trading market post-listing. So, yeah, you might buy the shares, but there's absolutely no guarantee you'll actually be able to sell them easily at a price you like once they hit the open exchange.
So, we've just given you the ultimate cheat sheet to decoding an IPO. We stripped away the jargon to reveal the timeline, the structure, and those crucial hidden risks. But the real question is this. Now that you actually know how to navigate the 400 pages of a prospectus, are you still willing to just blindly follow the IPO hype? Or will you actually look for the catch before risking your hard-earned capital?